welcome back to Part 7. In one view, the higher moment models to some degree try to rescue efficient markets. Investors are pricing more than the first two moments. Since CAPM prices assets based on the first two moments, the appearance of inefficiency is only a mismatch between two-moment models and higher moment models, and this is why CAPM does not work as well as we would like, meaning markets would be measured as efficient if measured through the lens of higher moments. That's one view. A multifactor model makes the case that either CAPM is fundamentally incomplete or markets are inefficient. Whichever it may be, adding additional factors might remedy the incompleteness or inefficiency. By considering not just market returns and covariances in the model, but other systematic factors that influence returns, we could get a better understanding of market dynamics. To cut to the chase on this, let me say that there are two main multifactor models that have had the attention of investors and academics alike. One is the Fama-French three-factor model, and the other is the Fama-French-Carhart four-factor model. The Fama-French three-factor model has the following three factors. 1. The same first factor as CAPM, which is the excess return of the market, or the return of a broad market index, scaled by beta. So all is good, nothing much new here in the first factor. The remaining two factors try to capture two apparent inefficiencies or perhaps deficiencies, depending on your perspective. One is the small stock effect, which is the observation that small company stocks outperform large company stocks on a risk-adjusted basis over long periods of time. This factor is captured statistically by a factor called SMB, or small minus big. Just as with the first factor, the sensitivity that a stock or portfolio has to SMB is scaled by its own beta. The third factor is a value factor as measured by book-to-market ratio, called HML, or high minus low. High book-to-market value minus low book-to-market value. This factor also gets scaled by its own beta. The risk-free rate is included, and also an error term for each time period. The different betas are estimated by ordinary least squares regression. Because of the other two factors, the first beta that scales excess market returns will not have the same estimated value as it would in the single factor CAPM. With the multi-factor model, some of the other factors do the heavy lifting that was previously accomplished by one factor. It looks like this. The Fama-French-Carhart four-factor model has the same first three factors as the three-factor model, with the addition of a momentum factor. These models have much higher predictive accuracy than CAPM. At first glance, with this higher accuracy, it would seem the difficulties are solved or mostly solved and we can move on to other problems. However, there are a few relevant criticisms. The first criticism is that multi-factor models are statistical or empirical models, not economic models. The inputs are driven by data. If the data were different, the model would be different. CAPM was developed by economic reasoning. The data to test it came later. The three-factor and four-factor model are fitted models. The data determine what the model is. Factor models continue to be invented because to date none of them sufficiently satisfy investors. There has been a proliferation of multi-factor models. Even Fama and French have updated their model to a five-factor model, including a profitability factor, RMW, robust minus weak, and an investment factor, CMA, conservative minus aggressive. The fact that there are several multi-factor models out there indicates indirectly that there is dissatisfaction with each particular multi-factor model. Otherwise, no one would go through the effort to create a new one. Some other multi-factor models include low volatility as a factor, which this series of videos will eventually address. Adding factors increases the likelihood of multicollinearity, where one factor can be estimated by another factor. Adding one new factor may eliminate the need for a previous factor, or perhaps two new factors together can do the work that three others used to do. Whatever is going on, multicollinearity means that one factor can seem to predict partially the outcome of another. When this is the case, what the underlying contributing factor really is remains an open question. In defense of multi-factor models, the apparent inefficiencies that multi-factor models account for might not be inefficiencies. There could easily be hidden risk that systematic risk does not price properly, but gets priced in things like SMB or HML. If this is true, then the small cap effect and value anomaly are not anomalies. Their risk is just incompletely accounted for by traditional systematic risk. For instance, small companies tend to have a higher cost of capital than large companies. This is an increased risk which gets priced and leads to higher alpha as measured by traditional systematic risk alone, but would not lead to higher alpha if risk were properly measured. Finally, multifactor models quantify return anomalies more than explain them. In the final analysis, I find that the factors of multifactor models are more descriptive than explanatory. That is, the factors acknowledge that there are mysteries. The value effect, the small stock effect, and other so-called anomalies are mysteries that get quantified to some degree in the multifactor models. I don't see that the factors are explained such that we understand them better. They are only quantified better. Of course, others may see it differently.